Newmont, the king. They just keep pumping out cash flow. $1.6 billion in Q3 alone. And gold keeps rising, driving that cash flow even higher. What more could you possibly want? Well, if you're the market, you probably want better forward guidance, which is what all the talking heads are blaming Newmont's fall in the markets on, after the release of their Q3 financial results. And if we're being honest with ourselves, despite free cash flow being $1.6 billion, it was not a new record for the company, with Q2 free cash flow higher despite a lower averaged realized gold price in that quarter. So what happened? Let's dive in. Newmont in the third quarter posted top-line revenue of $5.5 billion, which was a 20% improvement year-over-year from $4.6 billion in Q3 of 2024. Revenue was up a far less dramatic 3.9% on a quarter-over-quarter basis, from $5.3 billion in the second quarter. That revenue figure follows year-over-year improvements in the sale of gold, silver, lead, and zinc, with only copper seeing a reduction in sales on a year-over-year basis. Obviously, gold led the pack in terms of sales, with an 18.4% improvement year-over-year, with revenues rising to $4.7 billion. Silver had a more dramatic increase of 99% in revenues. However, it only accounted for $293 million in top line, while copper accounted for $319 million, zinc $191, and lead for $52. Average realized gold prices during the quarter, meanwhile, hit a new high of $3,539 an ounce, versus $2,518 an ounce a year ago and $3,320 an ounce in the second quarter. Net income nearly doubled in Q3 on a year-over-year basis, rising from $924 million or 80 cents per share to $1.8 billion or $1.67 per share in Q3 of 2025. Net income, however, was down from $2.1 billion or $1.85 per share in the second quarter. On an adjusted basis, net income improved from $936 million, or 81 cents per share, to $1.9 billion, or $1.71 per share on a year-over-year basis. Adjusted net income was also up quarter-over-quarter, rising from $1.6 billion, or $1.43 per share in Q2. EBITDA followed a similar trajectory, rising from $1.8 billion in Q3 of 2024 to $3.2 billion in the third quarter of 2025, while being down from $3.8 billion in Q2 of this year. While adjusted EBITDA moved to $3.3 billion, up from $1.97 billion in Q3 2024 and from $3 billion in Q2 of this year. Free cash flow, meanwhile, came in at $1.6 billion, which was down from $1.7 billion in the second quarter, but more than double the $760 million reported in the third quarter of last year. The trajectory here, however, appears to be not so positive, with Q3's decline attributed to working capital declines of $286 million. Well, Q4 is again expected to see free cash flow slide as a result of improvements being made at Yanacocha and severance payments. Newmont ended the quarter with $5.6 billion in cash, a decline from $6.2 billion at the start of the quarter. Debt, however, declined by $2 billion, with Newmont ending Q3 with a net debt position of just $12 million, versus net debt of $1.4 billion at the start of the quarter, which is after $823 million in capital being returned to shareholders in the form of a 25-cent per share dividend and share repurchases totaling roughly $300 million. The slide in performance in the third quarter relative to Q2, ironically enough, appears to be a result of Newmont's massive asset divestment program that they undertook over the course of last year. Production in the third quarter totaled 1.4 million gold ounces, as well as 35,000 tons of copper, which was the worst quarter operationally for Newmont in over 2 years. Q3 of last year saw 1.7 million ounces of attributable gold production comparatively, while the second quarter of this year saw 1.5 million ounces produced. And at this point, it's unclear if that decline is going to stop, considering it was in play before the whole divestment initiative started. The decline this quarter was blamed on lower gold grades alongside planned shutdowns at both Penasquita and Lahire, and the end of mining operations at both the Subika open pit and Ahafo South. Those declines were offset partially by improvements at 3 mines, but obviously not enough to make up the shortfall again. Of Newmont's 11 managed core assets, production improved at only 5 operations on a year-over-year basis, while 2 of 3 non-managed operations saw improvements. Yanacocha was the standout here in terms of improvement, with production rising from 93,000 to 152,000 ounces year-over-year, while Ahafo saw production fall from 213,000 ounces to 145, more than offsetting that gain. In terms of costing, on a co-product basis, Newmont saw its cash costs fall from $1,207 an ounce in Q3 of last year and $1,215 an ounce in the second quarter to just $1,185 in the current quarter, while co-product AISC fell from $16.11 an ounce in Q3 2024 and $15.93 an ounce last quarter to $15.66 an ounce in the current quarter. The company also indicated that they have officially completed that asset divestiture program, raising estimated gross proceeds of $4.9 billion, which includes contingent payments and closing adjustments. $2.6 billion has been received to date of net cash proceeds, plus $900 million from equity share sales. In terms of the outlook for Newmont, this appears to be what drove investor sentiment down last week, causing the sell-off in the equity. Starting with the fourth quarter, production guidance is estimated at 1.4 million ounces, enabling Newmont to maintain that prior 2025 guidance of 5.9 million ounces of production for the full fiscal year. Costs, however, are expected to go up, with cash costs of $12.60 and AISC of $16.70 an ounce predicted for the fourth quarter, which for the full year translates to cash costs of $1,200 an ounce and AISC of $1,630 an ounce, which is in line with prior guidance. Sustaining capital spend for the full year, meanwhile, is expected to come in lower than prior estimates, dropping from $1.8 billion to $1.7 billion for the full year 2025, while development capital spend has slightly improved from $1.3 billion to $1.28. Exploration spend has also been cut from $525 million to $450, alongside a cut of $85 million to general and administrative expenses to $390 million, a $45 million cut to interest expenses, bringing that line item to $255 million, and a $125 million reduction in reclamation and remediation accretion, which is now expected to come in at $350 million. Looking to 2026, production is expected to be within the same guidance range provided for 2025, but toward the lower end, meaning production is expected to continue its year-long trend of sliding downwards. The lower production is said to be a result of planned mine sequencing. As for costing, Newmont did an excellent job of politicking, stating, building on the cost and productivity improvements achieved in 2025, the company expects to realize the full benefits of its cost-saving initiatives, which will be reflected in the 2026 guidance to be provided next year. However, these benefits could be offset by increased profit sharing, royalties, and production taxes if gold prices remain elevated into 2026. So in other words, savings might not be as good as previously expected. Capital spending, meanwhile, is expected to go up as a result of projects advancing, including a potential expansion at the Red Chris mine and tailings at Cadia, and thus the sell-off. All right, so let's wrap it up. On the one hand, it was a great quarter for Newmont. It's tough to complain when there's $1.6 billion in free cash flow, especially when their closest peer, Agnico, isn't anywhere near that level, at least not yet. Q2 free cash flow for Agnico was $1.3 billion comparatively, and that was a new record for them. But after digging into the results a bit, we're not going to say that the sell-off here post-earnings wasn't justified. Free cash flow was down from Q2, and their outlook suggests production will continue to slip, while costs don't seem to be falling as much as they had initially expected post-divestment. In any case, if they want to stay on top and continue to wear the crown of the sector, they've got their work cut out for themselves. All right, everybody, we are in the thick of earnings season. We're going to have lots of earnings videos on this channel for you. So if you want mining earnings videos, check out our channel. Also, if you want more content, check out our website over at thedeepdive.ca. And if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thank you for watching.